blame game goes on. Turmoil in the financial markets has the fingers of blame pointing every which way, and that includes the ratings agencies. Blamed for making downgrades too soon or not soon enough. And how come AAA-rated companies all of a sudden get downgraded and then are junk bond status, Dylan?
Joining us in a first on CNBC interview, Standard & Poor's head of financial institutions ratings, Jay Drew. Jay, the ratings agencies, your agency and that of Moody's, were directly complicit in the creation of the securities that you now are like a 2-year-old with a bazooka blowing people's heads off with. I'm curious why you've made this decision.
Can you help me? Which decision are you talking about?
The decision to basically force massive financial institutions to come up with tens, and in one case, nearly $100 billion in the matter of a couple of days.
Well, it would be helpful to step back and look at what our role is. We are focusing on credit worthiness of entities. We're not making investment advice. We're not talking about pricing, liquidity,
We understand that. I guess the reason I think that I asked the question is, and I appreciate that clarification, is largely driven by the fact that the securities themselves, you and your institution deem to be very creditworthy. In fact, we're directly complicit in the creation of large numbers of these securities, which now it turns out you were wrong, sir. These were not AAA credits or AA credits as your agency deemed them to be.
Well, I think there are a lot of factors that are going on, and I think the key part is there is a lot of volatility in the market, and what we're looking to do right now is to reflect that in the creditworthiness of the financial institutions that we rate.
I'm curious, are you able to evaluate the decisions that you are making in the context of everything else that's going on? Are you aware of everything else that is going on when you make the decision to exacerbate an already distressed situation that your agency was complicit in helping to create?
And I think I appreciate the opportunity to comment on that, because it is important to talk about the perception in the market right now is that there is tremendous volatility. The fundamentals don't matter. There is hysteria.
Well, you're not answering my question. In the interest of time, there's an issue of making the decision to call the securities that you approved and rated as AAA, and now you return to indict the very securities that you yourself deemed to be creditworthy at the expense of the entire financial system. Yeah. I'm not holding you solely responsible, sir. I would not go that far by any stretch. I am curious what the thought process is, however, inside of your agency, knowing what the rating was going in, knowing what your role was in creating that rating, and knowing what your role is now in creating insurmountable time windows for large financial institutions to deal with the consequences of their bad judgment and yours.
And that's why we need to focus on what is the impact on the financial institutions that we're rating. And that is where our actions have been. The actions we took on Bank of America, the actions we took on AIG have been focused on what is the impact on those entities of a number of different factors that are going on in the market. And from AIG's perspective, we think actually that the Fed move right now is a helpful one. And that's why we left
You forced it. Not you didn't force it. That's not fair for me to say. But the ratings agency's decision to do what they did this week, when they did it, created the need for financing in this closed window. Now, I am not excusing AIG, which clearly took excessive and undue risk. Clearly.
Yeah, I don't think that that's an accurate assessment. I think what we did was we looked at all the information that was out there, quantitative and qualitative, market sentiment as well as fundamentals, and we made the decision based on what was out there. So I think the characterization you have is really not accurate. What our role is to focus on what the fundamentals are and reflect that.
Well, Mr. Drew, let's then talk about the fundamentals. Take us through specifics as far as how you gauge the health of these companies. For example, there was a moment in time when you and your colleagues from Moody's and Fitch decided to incorporate a company's stock price as part of the health of that firm. If the stock price is higher, there's more confidence in the firm. That doesn't sound logical to me, given the fact that a stock could be anywhere for any number of reasons. That's one of the ways you're gauging the health of companies. Tell us exactly what measures you're using.
I think that is a very good question, because clarification is important in that. The role market information plays a role in our analysis, but it's not the primary role. Primary role is fundamental analysis, quantitative and qualitative analysis of where we see the business going, where the fundamentals are from a profitability, liquidity, financial flexibility standpoint. Where market sentiment comes in is really looking at... I'm going
to get in here just on time issues. It is clear that you were wrong in your rating of the collateralized debt obligations in the first place. Will you agree to that? That these were not, it turns out, AAA credits.
Well, there's a lot of different factors in there. I think
understand
that's
there's a lot
simple.
of factors. I recognize it's a very complicated world. Your very high credit rating of collateralized debt obligations that have turned out to have a much higher risk of default than your credit rating would suggests to me that your credit rating was inaccurate. Do you dispute that?
What we are looking at is credit worthiness. There is a lot of different factors. Volatility, you've got liquidity.
I understand
so
that.
far, I still don't know the measures that you're looking at, and you're not answering the specific question as far as the credit default swaps.
Well, that's because you're not letting me answer it.
Okay,
Let me answer
please go,
it.
sir.
So the way that the equity pricing comes into our analysis, that was your question, Maria. The way that it comes into our analysis is even during good times, you need to know what the equity markets are doing, because that's an important part in your capital raising. It's an important part in your liquidity planning. Especially during tough times, it is an important part, because AIG needed the liquidity, and what the Fed facility did was it gave them the ability to call a timeout. And that's what
with all due respect, I don't see how it is that you can applaud the Federal Reserve from the chair that you sit in. I am speechless. Are you telling me that you believe that the creditworthiness ratings of collateralized debt obligations at the outset of those securities is one that you believe was an accurate representation of the creditworthiness of those instruments at the time that you rated them, sir?
No, I was responding to Maria's question about AIG.
I understand that, and I don't want to play a shell game of who asked what who. There's been too much nonsense.
There are two main issues that we're trying to get at.
I just would like to complete this one thread, and then I won't talk for the balance of the day, I promise.
Okay.
I want to know, sir, whether you believe that the instruments, the collateralized debt obligations that you rated AAA, do you believe that was an accurate rating of those instruments, yes or no?
I'm not the analyst, and I don't...
you're not going to answer the question. My point is this. You may well be wrong in your assessment of the credit now as you were wrong in the assessment of the credit then, sir.
Will you
acknowledge that
question.
possibility?
Sorry?
Will you acknowledge the possibility that you could be wrong in your assessment of credit now, much as you were wrong in the assessment of credit in the previous rating of collateralized debt obligations?
I don't understand where you're going with your question. Where I'm
going is you helped to create the problem, and then you controlled the timetable for the dissolution of the problem you helped create, sir. Your institution. I don't mean to personalize it.
No, fair enough. But I think you have to remember, what is our role? We are looking at the credit worthiness. We cannot look at the consequences, because that's not what we control. What we control is how we assess credit worthiness of a company, and that's what we do. In the case of AIG, in the case of any.
So how did you assess the creditworthiness of the credit default swaps?
Of AIG itself, we thought that that there is incremental risk in AIG. It's still a very strong operation. You got to remember that. It's on the insurance side, it's A+. We think it's still a strong operation. Today, we changed the outlook to developing, which means that there is a possibility for an upside on the insurance side.
Mr. Drew, final question here.
Yes.
Let me ask you this. In looking back over the last year, what could Standard & Poor's have done better?
There are a lot in any time we're constantly learning, and one of the things that we had to do was better explain the ratings, and some of the actions we've taken are better explaining it. It is about creditworthiness. It is not about liquidity, volatility, pricing, and I think the market and many of the investors, the sophisticated investors, know that. A lot of the things were attributed to the ratings that it didn't apply to. It is about creditworthiness.
So are you going to change the way you operate? Are you changing the way you do business, specifically when it comes to looking at a company's stock price as a measure?
It is going to be one component of our analysis. It is not the component, but it is one component.
So are you changing the way you look at companies today? Are you changing anything you do going forward?
We've made a lot of changes, as we always do. We always learn from what's happening in the markets. And one of the ways that we're looking at is investor education, looking at liquidity and what role it plays. And that's always been part of our analysis. But I'm sure coming out of this, there'll be a lot of things that we'll learn.
Mr. Drew, nice to have you on the program. We appreciate you talking candidly about these issues of the day. We know it's not easy, and we don't mean to be personalizing this. We appreciate your insights. Thank you.
My pleasure.
Thanks very much. Jay Drew.